Good afternoon. I'd like to wrap up our Treasury note futures trade today. Today was a Newsday trade. We wanted to be sidelined in front of the news because you can never know with 100% certainty what the news will bring. And today we had a huge surprise to the downside. Now notice how volume held the market. So this is our first clue that the low might be in. By this little volume bulge right here that pulled the market to it. As the day progressed, the E-mini started to sell, and this made the treasuries gain in strength too. But the first trade of the day was to find a place to sell it after the news hit, and we'd identified 4 to 8 as our sell zone. And the actual trade was 3 to 7. Our sell. We said if we did not make new lows, or take out this high volume area right here, we could trade from the long side. So how do you put these trades on? It's very easy to talk about putting a trade on, but you have to have a methodology, you have to have a trigger, you have to have your setup, you have to have your entry management and exit rules. So you can see that we had on the break in the news a lot of volume poured into the short side. The market did rebound off of profit taking, which you'd expect, and you want to sell in to the first rally. So we have the top of the value area high on our first bar. We've got a low volume number over here at 2.5, and then we have a low volume number at 7. So the first trade took place when you broke this bar's low on a sell stop, and that had you short at 124, 123, 31.5. We said if the market did not make a new low, get out of the trade. And so right here we did not make a new low, and you can see right here in this bar that the mode flips above the mean, and this is a P shape. So when you break this bar's high right here, that's as long as you can be short. So you make a 30-second give or take on this particular trade. We've got a higher low right here. We still looking to the short side of the market. We put out a 3 to a 7 sell, and the market rallies up, stops at the mean green line at 4, so you could be short at 3, and the trade doesn't develop, so you're looking at a scratch if you're really nimble, or a small loss of 3 ticks. And then the E-mini starts to sell, and right here in this area we get a beautiful retest failure to the long side. You can be long in the 5.5 area, and the market trades up to 29 for a huge trade. So you had a shot at 24-30 seconds on this particular trade. So when news hits, if you don't position in front of the news, you give up a tremendous amount of trade location. If you don't extend the range of this long bar, you can trade from the opposite side. We didn't, so you could have actually traded from the long side down in here. But clearly when the market broke out because of the E-mini selling, it was a trade from the long side, and the market gave you a huge trade. So you had 1 tick that you made, you minus tick and a half. So you're minus 0.5, and you had a shot at 24, upwards of 24, so you had a potential to make 23, 30 seconds, and everything in between. Most people probably would have taken themselves out at 16 on that move. That's a half a point or $500, but there was more for you in that particular trade. So making $450 to $500 would be pretty realistic on this particular trade, and we had a great day trading the note after the news hit with some help from the E-mini. Looking forward to talking to some of you in our room. Come on in, learn our methodologies, our trade setups, how we derive our trades. Looking forward to working with some of you in the future.